In this video, we will go over an exercise in Chapter 8. It's short exercise 5, or S8-5, and we're going to look at the journal entries for using the allowance method to account for uncollectibles. So let's look at this exercise and read the requirements. First of all, in the first paragraph, it gives us the beginning balance of accounts receivable and the allowance for bad debt. So let's go ahead and enter those balances. The beginning balance of accounts receivable, it tells us, was $10,800. Okay, and allowance for bad debt was a $2,000 credit balance. Okay, so we're going to start with that to work with, and then we're asked under the requirements we need to journalize the transactions for 2016, assuming we use the allowance method. So what this means is the company does not use the direct charge-off method. Okay, so let's record the journal entries and then we'll do our posting for requirement 2. So first thing we need to do is record the journal entry for transaction A. And transaction A said sales revenue on account $265,800. So what we would do for transaction A is we would record a debit to accounts receivable and a credit to sales for $265,800. So that's our entry to record sales on account. And ignore cost of goods sold, assuming we're not using the perpetual inventory method is what that means. On transaction B, we need to record collections on account of $220,000. When we collect on account, that means accounts receivable needs to go down and cash needs to go up. So we would debit cash to increase cash for $220,000, and we would credit accounts receivable. Okay, and in transaction C, we need to write off uncollectibles. When we record a write-off under the allowance account or the allowance method, our journal entry is different than the direct write-off method, but how we would record this transaction to write off uncollectibles, these are the customers that we know will not pay. Maybe they called and said we're in bankruptcy, or we've tried repeatedly to contact them, collect the information or collect the money from them. So in transaction C, we're going to debit the allowance for bad debt account and we would credit accounts receivable to remove the account from our books. So we would debit the allowance account for $6,100 and credit accounts receivable for $6,100. So next, let's move to transaction D. Transaction D says bad debt expense of $5,000 was recorded, and we are going to look at that with some different methods and how to calculate this $5,000 in other videos. But to record our bad debt expense, we would record a debit to bad debt expense for $5,000, and we would record and credit to the allowance for bad debt account. Okay, so this is requirement 1. We've journalized all of the transactions. And what we're going to do next is we are going to post those transactions. And we're going to post them to the accounts that we had started here on the right. So looking at the first transaction, we would record the debit to accounts receivable for $265.8 as a debit. So we've posted this first one. And then we're not looking at the sales account specifically, but you would post it in your ledger or accounts also. The next entry, transaction B, you would post in the ledger to the cash account, but that's not our focus for this problem. So assume that one's been posted. And the part that we need to post for accounts receivable will be the credit. When we collect from customers, we credit or make accounts receivable go down. So we've posted this one. And for transaction C, we recorded a debit to the allowance account to write off an account. Okay. Now notice at that point, we would end up with a debit balance in the allowance account. And what that would mean at that point is we wrote off more than we estimated. So we've got 6,100 versus 2,000 there. So we've posted that debit to the allowance account. We would credit the accounts receivable 6,100 to remove the account. We did that. So we've posted this one. And next on bad debt expense, this is our estimate. We would record the $5,000 for this time period. That's our estimate. So we've posted this next one. And then we would post allowance for bad debt, a $5,000 credit balance to increase the allowance account. So that is requirement 2 that we had, which said post the transaction to the accounts receivable and all the T accounts that we had opened. We need to determine the ending balance of each account, so let's do that real quick. On accounts receivable, we have 2 debits, $10,800 and $265.8. And then we would subtract our credits of $220,000 and $6,100. So add your debits and then subtract your credits. And we should be left with a balance of $50,500. And it doesn't hurt to double check your work. Okay, and then on the allowance account, we need a new balance. We've got 6,100 in debits and 7,000 in credits, or $900 left on the credit side. And then for bad debt expense, there's really no calculation needed, but when you're doing your homework in the software, it does want you to put an ending balance and put it on the normal balance side, which would be, in this case, a debit. So we've completed the journalizing in requirement 1. We posted to our T accounts in requirement 2. And next we need to show how would accounts receivable look on the balance sheet. Okay, so this will just be part of the balance sheet. Okay, and how it would look on the balance sheet from our information that we had our accounts receivable balance. Which was 50,500, and you would say less the allowance for bad debt, and that was $900. So this is what our balance sheet would look like. We would be reporting the net amount of $49,600. And this would be on the balance sheet, and this would be in the current asset section since accounts receivable is a current asset. So you would show the accounts receivable, and then you show the allowance account. The allowance is a contra asset account, meaning it has the opposite balance of accounts receivable. Accounts receivable has a normal debit balance, and then our allowance account has a normal credit balance, and we would show the net receivable amount of $49,600 on our balance sheet. So that was our short exercise 5 on page 456 in the 5th edition of the textbook.